Assalamualaikum warahmatullahi wabarakatuh. Today I will explain the initial measurement of inventory under MFRS 102, specifically the cost incurred in inventory cost and the calculation of the initial inventory cost. Under MFRS 102, the cost of inventory includes all costs incurred to acquire the inventory and bring them to their present location and condition. Based on the given information, the costs incurred in inventory costs are purchase price, import duty, and freight inward.
Identify costs that should be excluded in inventory costs. Administration expenses. Justify your treatment based on MFRS 102. According to MFRS 02, based on paragraph 10, the cost of inventory should cover all cost of purchase, cost of conversion, and any other cost faced in bringing the inventories to their present location and condition. For the item to include and deduct, paragraph 11 explains that the cost of purchase consists of the purchase price, non-recoverable import duties, and transport or handling costs that are directly linked to acquiring the finished goods. The same paragraph explicitly notes that trade discount and rebates must be deducted when calculating the purchase cost. This is directly justified adding the import duty and freight inward while subtracting the trade discount. For the excluded items, paragraph 16C states that administrative overhead that do not contribute to bringing inventories to their current location and condition cannot be included in inventory costs. Instead, they must be recognized as an expense in the period they are incurred. This is why the 2,000 ringgit in administration expenses is left out of the calculation.
Next, the calculation of the initial inventory cost is as follows. Purchase price Rm 130,000 at import duty Rm 6,000 at freight inward Rm 4,500 less trade discount Rm 3,000. Therefore, the total initial inventory cost is Rm 100 to 27,500. Thank you.
So, moving on to our closing inventory at the end of the year. Under MFRS 102, we cannot just list our inventory at whatever we paid for it. The standard requires us to measure our closing stock at the lower of its cost and its net realizable value, which we call NRV. So, a really important rule here is that we have to do this comparison item by item. We can just look at the grand totals. We have to look at each individual product lines. So, let's look at the number for bright mart trading. First, for product A, the original cost is Rm 20,000, but its NRV has dropped to Rm 18,000. Since 18 is the lower amount, that becomes our final carrying amount. This means we need to record an inventory write-down of Rm 2000. Next up is product B. This one has a cost of Rm 15,000 and an NRV of Rm 17,000. In this case, the historical cost is lower because we never write inventory up above its cost under this rule. So we keep it valued at Rm 15,000, meaning there is zero write-down needed. Finally, we have product C. The cost is Rm 10,000, but its NRV is only Rm 7,000. The lower number is the NRV of which is Rm 7,000. So that's our carrying amount. So this leaves us with a write-down of Rm 3,000. So if we add up our final figure, the total carrying amount for our closing inventory that will appear on our balance sheet is exactly Rm 40,000. At the same time, when we combine the drop from product A and product C, bright mart has to recognize a total inventory write-down expenses of RM 5,000 in this period's profit or loss statement.
Okay. Inventory write-down analysis. Product A, write down RM 2000 because NRV RM 18,000 is lower than cost 20,000 in accordance with MFRS 102. Inventory is measured at the lower of cost and NRV. Product B, no write-down required because NRV 70,000 exceeds cost 50,000. Therefore, the inventory remains recorded at cost. Product C, write down RM 3000 because NRV RM 7000 is lower than cost RM 10,000. Then the product became obsolete due to technological change, reducing its expected selling price. Total inventory write down RM 5000.
Now we will discuss how inventories are recognized as an expense under MFRS 102. According to the standard, inventory is not treated as an expense the moment it is purchased. Instead, it is recorded as an asset on the statement of financial position. It is only when the inventory is sold that we transfer its carrying amount to the statement of profit or loss as cost of sale. We ensure the cost is matched against the specific period in which the revenue from that sale is generated. This recognition process directly dictates our gross profit. If we do not value our inventory accurately, we effectively manipulate our profit figures. For example, if we overvalue our closing inventory, our cost of sale appears lower than it actually is, which artificially inflates our reported profit. Conversely, if we undervalue our inventory, we overstate our expenses and suppress our profit. Ultimately, these valuation errors misrepresent the company's financial health to all stakeholders. That's all from me. Thank you.